Hello, welcome to Chapter 5. Today we're going to be talking about professional auditing standards and the audit opinion formulation process. So this is where we start to implement all of the background practices, standards, and principles that we've been talking about so far this semester. First, we're going to talk about the auditing standards and how they provide guidance to form an audit opinion. There's different professional accounting standards. We've talked about a lot of these in the past. The AICPA, the PCAOB, and the IIASB, which is the international body. They all have a common objective: to provide assurance to the public that audits are conducted in a quality manner. So if you remember from our last class together, we talked about how one of the defenses against litigation for an auditor is to show that they've performed a quality audit. In order to be able to do that, they need to show that they've followed the professional auditing standards that are in place by these various bodies. The auditing standards apply to their task of developing and communicating an opinion on the financial statements, and if you have an integrated audit, it also applies to the client's internal control or financial reporting. The standards that are relevant to auditing depend on the type of organization that you're auditing, where the organization is located, and which stock market it's publicly traded on. So there's different bodies and different standards that you need to follow depending on these three criteria. Here's a comparison of U.S. and international audit standards. It's listed out by the authority, the terminology, the scope of the applicable standards, and if any of them converge. So you can see that the PCAOB currently does not have any mandate for international convergence. Convergence means that they try to come together to be similar as opposed to having any variances or differences among the standards. So let's talk about the foundational principles. The PCAOB guidance has 10 different standards. They relate to general standards, fieldwork standards, and reporting standards. General standards are applicable to the auditor and audit firm and provide guidance in selecting and training their professionals to meet the public trust. Fieldwork standards are applicable to the conduct of the audit, and reporting standards are applicable to communicating the auditor's opinion. The AICPA, The AICPA has developed 7 fundamental principles that govern audits, and they're broken down into 4 different categories: purpose of an audit and premise upon which an audit is conducted, responsibilities, performance, and reporting. There's 5 different phases in the audit opinion formulation process. The first is making client acceptance and continuance decisions. The second is performing risk assessment. The third is obtaining evidence about internal control operating effectiveness, if applicable. Phase 4, obtain substantive evidence about accounts, disclosures, and assertions. And finally, in Phase 5 is where we complete the audit and make reporting decisions. We're going to talk about each of these phases. So you may or may not have heard of the term accounting cycles. An accounting cycle are similar transactions that are linked by procedures and controls that affect the related accounts. So it's an easy way to break up the audit into manageable sections of related accounts. Individual auditors or teams of auditors are typically assigned to audit a particular accounting cycle. Some examples may be a cycle where you have acquisitions and payments for inventory, goods, and services. There are several related accounts that are impacted by this accounting cycle. The related accounts could be accounts payable, inventory, expenses, other assets, and cash. Another accounting cycle may be acquisition payments for long-lived assets, which also impacts a variety of accounts. The auditor focuses on flow of transactions within a particular cycle. They need to identify the points where material misstatement can occur and also identify the controls that have been designed and implemented to mitigate those risks. A typical audit procedure during the planning phase of the audit is to sit down with the client and do a walkthrough of the various accounting cycles. What that means is that you'll sit down with the client and actually walk through what happens from the beginning of the cycle to the end of the cycle. And based on that, you can make assessments about where is there a chance for material misstatement and what controls does the client have in place to mitigate those risks. Understanding risks and controls within each cycle helps determine specific audit procedures to be used and specific audit evidence that we should be obtaining. So management's financial statement assertions and PCAOB standards. When you're planning an audit, what you're really looking at is the assertions for each of the accounts that you're auditing. Each of these standards apply to various accounts, and they apply to both the balance sheet and income statement accounts. First, we have existence or occurrence. Existence refers to assets and liabilities, whether or not they actually exist. The client says that they own a building in Florida. Do they actually own that building? Does it actually exist? Occurrence is for an income statement account. The client says the sale occurred and recorded revenue. Did the sale actually occur? Completeness refers to inclusion of all transactions accounts in the financial statements. This can refer to balance sheet or income statement accounts. Valuation or allocation refers to inclusion of accounts in the financial statements at the appropriate amounts. An example of this may be when you buy inventory. Did you record it at the correct cost? Is it the right value? Okay. Rights and obligations refers to assets being the rights of an organization and refers to liabilities being the obligation of an organization. So do we actually have the right to that asset, and is that an obligation? Do we actually owe that to someone else? And then finally, presentation and disclosure refers to components of financial statements being properly classified, described, and disclosed within the financial statements. Our audit procedures always go back to these 5 assertions. This is how we determine how we're going to perform our audit test. We'll keep coming back to these throughout the semester. So what is audit evidence and what are audit procedures? This is the core of the audit. Evidence is information used by the auditor in arriving at conclusions on which the opinion is based. These are various work papers. Audit procedures refer to the procedures designed to obtain the audit evidence to support our audit opinions. So this is how we're obtaining our documentation. Sufficient and appropriate audit evidence is a measure of the quality and the quantity of that audit evidence. You need to make sure that your audit evidence is sufficient and appropriate given the level of risk of the assertions in the account that you're auditing. Don't worry, we'll talk about what all that means. And then finally, the audit program is where this is all recorded. So it lists the audit procedures that you're going to follow in gathering the evidence, and it helps monitor the progress and supervise the work that's being done. So there's 3 main categories of audit procedures. So any audit procedure that you're performing will fall into one of these 3 categories. First is the risk assessment procedures. So this typically happens during the planning phase of the audit, and it's the procedures that you perform in order to provide information for assessing the risks of material misstatement in the financial statements. Next, once you've identified those risks, you're going to identify controls that may or may not be in place. If there are controls in place, then you need to do a test of controls. This is designed to evaluate the operating effectiveness of those controls. We're going to touch back on this a little bit later. And then finally, we have our substantive procedures. These are designed for detecting material misstatement at the assertion level for the various accounts. It's comprised of tests of details and substantive audit analytical procedures. So audit documentation is a record of audit procedures performed, the relevant audit evidence obtained, and conclusions the auditor has reached. These are what's referred to as our work papers. Here is a list of different examples. You could have memos, a summary of significant findings. We usually refer to that as our summary memo. And then you also have a SAD, which is summary of audit differences, letters of confirmations, representation letters, audit program, different analyses, also client documentation. Any of these can make up your audit documentation. The purpose of the documentation is to assist the team in planning and performing the audit and supervising and reviewing the audit work. One of the doctrines that came out of the PCAOB is if it's not documented, then it's not done. You may have performed a procedure or you may have determined whether or not something occurred at the client, but if you don't make a document or document that you performed that procedure, then it's as though it never happened. So retaining a record of matters of continuing significance help future audits. It enables internal or external inspections of completed audits, and it assists auditors in understanding the work performed in the prior year. It also provides documentation if there's any litigation that comes around from an audit. It's what you have to show that a quality audit was actually performed. So now we're going to talk about the different phases. So first is the client continuance and acceptance phase. So there's certain things that need to be present in order to accept an auditing engagement. Use of an acceptable financial reporting framework and agreement of management to acknowledge and understand its responsibilities. During phase 2 is where we perform our risk assessment. So we're going to be identifying and assessing risks of material misstatement. So the first thing that we need to do is we need to identify the significant accounts and disclosures that the client has, and then we need to determine the relevant assertions for those accounts. The auditor also establishes a materiality level overall and for each specific account and disclosure. So when we're determining our audit procedures, we're going to be responding to any identified risks during this phase. There's two different types of risks that we look at: inherent and control risk. Inherent risk is the susceptibility of an assertion about a class of transactions, account balance, or disclosure to a material misstatement that could be material before you consider any related controls. Okay? So you're going to have some accounts and some disclosures that are inherently risky. An example of this is cash. So we've talked about cash. That is a higher risk account. It's more susceptible to fraud. It's more susceptible to misstatement, regardless, before you consider any related controls. Then you're also looking at your control risk. This is the risk that a misstatement could occur either individually or in aggregate, and it won't be prevented, detected, or corrected on a timely basis by the organization's internal controls. Okay? So the control risk can be mitigated if a client has controls in place to prevent, detect, or correct a misstatement within the account or the assertion. Examples of control risk procedures are inquiries for information to assist in identifying the risks of material misstatement due to fraud or error, preliminary analytical procedures, observation of the process, and inspection of documentation. There's various forms of documentation that you can use to document our understanding of the organization's internal controls, which includes narratives, flowcharts, and questionnaires. The control risk assessment focuses on the design effectiveness and implementation. So if you have a high control risk, that means that the risk is high, that material misstatement could occur, which means that you have weak or ineffective internal controls, and therefore you cannot rely on those controls to reduce your substantive procedures, and you need to do more substantive procedures. If you have low control risk, that means that your controls are working effectively, and you can test the operating effectiveness of controls, therefore reduce your substantive procedures for account balances. So basically, if your controls are working appropriately, and you've tested that they're working as intended, then you have less audit work to do in terms of substantive procedures. And we'll talk about this again. The purpose of risk assessment procedures is obviously to identify the risk of material misstatement, determine where the misstatements can occur, and then to design your appropriate audit strategy. There's two different types of audits that result from this. You can do a controls reliance audit or a substantive audit. The controls reliance audit is what I just talked about. You're testing your controls and you're performing less substantive procedures. A substantive audit is performed when either testing controls is ineffective or inefficient, or you've determined that the client does not have appropriate controls in place, or they're not operating as intended. Therefore, you cannot rely on those controls and you need to perform a solely substantive audit. Selecting specific audit procedures in order to respond to those identified risks is part of the audit. You need to assemble an audit team that has the appropriate knowledge, skill, and ability to address the assessed risks. Emphasize the need for professional skepticism, and you need to ensure that the appropriate level of supervision is in place for the risk level that you've assessed. Phase 3 is where we're actually performing our tests about around the internal controls. So you're going to test the controls to determine whether they're operating effectively. If you have an integrated audit, those tests are performed at year-end. And if you're using this for a financial statement audit, you're going to be performing those tests throughout the year as part of your planning procedures or interim tests. Selecting the controls to test involves choosing controls that effectively indicate the capability to address the assessed risk of material misstatement for relevant assertions. So what does that actually mean? It basically means that you don't need to test all the controls that are in place. You're going to identify the controls that are most important and mitigate the risk of material misstatement for the relevant assertions that you're going to be auditing. The types of controls that you can do the types of tests you can do are inquiry, observation, inspection of relevant documentation, and reperformance of a control. Excuse me. You can test entity-wide controls, which reduces the number of control activities selected for testing, or transaction controls. Excuse me. If control deficiencies are identified, then you need to assess them in order to determine whether preliminary control assessments should be modified, and you need to record the implications for substantive audit procedures. What this means is that if initially you said that the control environment was effective, and as a result of those tests it is no longer deemed effective, that's going to have an impact on your substantive procedures. You may not be able to perform a controls reliance audit. If there are no control deficiencies identified, you still need to go back and revisit your control risk assessment to deem that it's appropriate, determine the extent that controls can provide evidence on the accuracy of accounts, and then determine your planned substantive audit procedures, which would be less if you're relying on controls. With any audit, the level of assurance is going to vary between the accounts, disclosures, and assertions. Here's an overview of the audit decisions leading up to decisions about the substantive procedures. So you need to follow each of these procedures from beginning to end before you can determine what your substantive procedures are. Okay. Phase 4 is the meat of the audit. So here is where we obtain substantive evidence about accounts, disclosures, and assertions. Our substantive procedures include substantive analytical procedures and test of details of account balances. In order to determine the appropriate level of substantive procedures, we need to identify the sources of potential misstatement and the extent of type of potential misstatement. And we also need to look at the results of our controls testing to see how much of our audit needs to be done by substantive procedures. And then finally, the final phase is the formulation of our audit opinion and completing the audit. Here we complete various review and communication activities. So we need to communicate with management regarding our findings, get a management representation letter, make a decision about what types of opinions should be issued, and decide on the appropriate opinion to be issued. It can be based on financial statements and internal control, and it can be issued in one report or two separate reports, depending if you're doing an integrated audit or not. So that's a quick summary of the different phases of the audit and opinion formulation process. We'll be talking more about this on Tuesday and going through some specific cases. And we'll be touching on each of these phases throughout the semester. As always, if you have any concerns or questions, please feel free to email me. Thank you. Okay, you.